I'm going to take you into a strategy that is going to knock your socks off. It's one you already know, but you've not yet learned how to use it in the direction that I'm going to share with you today. And when you do, it's going to make you a super business builder, because this strategy and this way it's structured is just absolutely phenomenal. And I think you'll feel free to email me your question at .com. I'm going to start out today with a history lesson. So many times people think, I want the latest new strategy. I want to know the latest new thing and the hottest this and the hottest that. Sometimes the hottest and best stuff was done 100 years ago, and sometimes even longer. There have been some incredibly bright people who have passed this way before us, and we can learn from them. And sometimes the best lessons we're ever going to learn are from some of the greats of the past. And so we're going to go into a little bit of a history lesson right now. I'm going to introduce you to a fellow whose name you probably already know. Most people know him as John D. Rockefeller. He was born July 8th in 1839, died May 23rd, 1937. And many people know him as the founder of Standard Oil. And if you measure his net worth at his peak in 2008 dollars, it would be $9 billion today. That makes Bill Gates and our good buddy at Amazon pikers by these standards. When John D. Rockefeller built his fortune, he controlled 1.5 to 2% of the U.S. economy. In other words, 1/65th to 1/50th of its GDP. He is the all-time grand master of building phenomenal enterprise businesses. And the question that I would like to ask you here is, do you think we could learn some important business principles from John D. Rockefeller? I want to tell you, we can. And the interesting thing is, some of his best stuff has been forgotten, and we're going to resurrect some of it here today. The thing that John D. Rockefeller taught entrepreneurs is control is more important than ownership, because with control, you can explode your ownership. And control is the key to building and developing enterprise businesses. And I want you to burn that into your head. Control. It's more important than ownership. And the reason that's important is you talk to most entrepreneurs, they'll tell you what they own. They'll tell you they want to keep 100%. They'll tell you they want to expand their ownership. And I'm trying to reorient you today to one of the greatest empire builders of all time. And control is more important than ownership. So burn that into your brain. And what John D. Rockefeller did is he learned how to maintain this phenomenal control of a tremendous enterprise, because he learned to leverage entities by serializing successive 51% ownerships. And I'm going to show you what he did. I'm going to flip that heading that came out of the center of the screen up to the right-hand side, because I want you to keep this in your mind. Leveraged entities by serializing successive 51% ownerships. So here's what he did. He founded Standard Oil, and he made sure that his ownership never went below 51% of Standard Oil. So that was his key in his mind. As long as I own 51, I own control. Okay? So it meant that he could give away 49% of the company to other people who could bring value to the company. But as long as he maintained 51%, then he was leveraging his ownership not only to what he had, but to what he could get brought into his company by giving away 49% of it. Okay? So it's an important concept. So when it came time to take more control of more stuff, he would form another entity and he would give away 49% of that, but 51% of it was always owned by Standard Oil. So his 51% of Standard Oil controlled Standard Oil, but it also controlled 51% of the next company that he formed, and gave away 49% of that to all the folks who could bring resources and money and assets into the company. And that's what he would do. So as soon as he gave away up to 49%, he'd form another company that he owned 100% of, and then gave away more and more of it until he only owned 51%, but he still owned control. He owned control of Standard Oil and the next company and the next company. And he kept doing this time after time, never giving away more than 49% of any company, having companies own companies where his 51% always maintained control of his entire empire. So all this time he's building up all these companies underneath Standard Oil, and he owns control of them, giving away all the values to other people, but never giving away that 51st. Okay, so hopefully you got this. See, this is a structuring of a business to leverage out his ability to control and leveraged entities by serializing that successive 51% ownership. In other words, that was his structure right there. This was so successful, it was made illegal. He took over such a big portion of the country's commerce at that time with the key fundamental industry of energy that everybody was afraid of him, because he was monopolizing the entire fuel industry. And the only way they could see to stop him was to make this practice that he was using to gain control, this practice of entity serialization of his 51%, that they made it illegal. Congress actually passed the Sherman Antitrust Act of 1890 to make this that you're seeing in front of you illegal. And then it finally got to the Supreme Court in a case against him, and Standard Oil lost. It was called Standard Oil Company versus the United States. It was in 1911, and they broke up the Standard Oil Company into 34 separate competing companies, so that they broke up this 51% of 51% structure that he had put together. And the irony is, 88 years later, A lot of these got recombined as ExxonMobil. Now, what do you think happened 88 years later? Nobody was around that was afraid of him anymore, right? And so it got forgotten what the legislation was. Intervening pieces of legislation got enacted that watered down the things that made his original system illegal. And by 1999, there was no resistance to monopolies in this anymore because the world of competition was so broad. And that enabled ExxonMobil to basically put a lot of this back together in 1999. The reason I'm sharing this with you is Rockefeller's strategy can be safely used today. The fact that it was made illegal by the Sherman Antitrust Act is long since forgotten. And the real key to it is you just don't completely dominate the market of a major economic sector. As long as you don't do that with it, you're safe, okay? So you can't carry this out to the extreme because the Congress of the United States will come get you, okay? The Department of Commerce will come get you by trying to reapply some of those what are now ancient antitrust laws. But as long as you don't go there to that level, you are totally safe using the structure to build out your companies. Now, whenever I cover anything, I like to know people have a takeaway. In other words, that the information that you just got here, that you have a takeaway, that you're going to take away some value to what you just heard here. And the value that you should be taking away is up to 49% of a company can be given away to make the 51% worth more. And if you're a John D. Rockefeller, you would do that in a heartbeat because every time you're doing that, you're adding value to what you're doing, but you're never giving up control, never giving up control. All right. So hopefully this is your takeaway. And if it is, you're going to find some valuable lessons here in that giving away up to 49% of your company to make the 50% worth more is smart business. It's smart to do that. Understanding this principle unlocks the door to the unlimited expansion of your business, unlimited expansion of your business. And I'm going to go through with you some examples and some additional information that's going to show you how to make that work for you. The first thing I want to do is, now that you understand that principle, that major strategy and major principle, I want to do a quick review with you of something you've learned here at Bizarre Financing. It's one of our methods of you gaining ownership in a business, and it's called the Buildup buy-in. So it may sound like I'm taking a little diversion from what I just shared with you, but I'm not. I'm going to bring it all back together. But I want to do a quick review of something you already have learned here, and it's called the Buildup buy-in. Now, you know this strategy as a method to gain ownership interest in a going business, where you earn income at a going rate as you go, and you gain a share in equity values you create. Okay, that's the essence of a build-up buy-in. I'm going to get deeper and deeper into it so that everything will be clear. With virtually no risk to the business owner, because what you do, you're getting paid market rate for the sales you're making or for whatever it is you're doing, but they part with equity only based on what you create for them. So they're only giving you some small piece of what you've created for them. All right, so they're paying for what they get. They don't pay anything unless they get it. They don't give up any equity unless they've got much more value added to their company than the part that's represented by the equity share that you've earned. So real important to understand that. And if you're going to use this strategy, of course, the first thing that you would need to do if you're trying to get into business using this strategy is, first, you'd identify a business that you can help grow, where you can provide one or more substantive, measurable deliverables. In other words, what can you deliver to that company that's measurable, that would be worth giving away some equity for that if you could deliver it? And here are some examples, okay? These are the things that enable you to do a build-up buy-in. Can you add sales? Can you bring in big purchase orders? Can you bring in new clients who will reorder over and over again into the business? Can you build up that sales capacity of that business? Can you do something within that business that reduces their cost of doing business substantively? If that happens, then that business is going to make more profit, right? And with more profit, then the business is worth more. And if it's a lot of profit that you're adding by a lot of reduced costs, then the company's becoming more competitive. It can outcompete. It can gain more sales because it costs less to do what they do. Very valuable thing that can be contributed to a business and earn you equity. Many ways that you can improve cash flow in a business, improve production of the business, open new locations for that business, raise capital for that business. All of these are ways that are measurable. We can measure what you did, and they're substantive, and there are deliverables that when delivered, you can justify why you're entitled to the equity, because the equity that you're getting, even though the owner owns a lower percentage, the percentage that they continue to own is worth a lot more. I'm going to go through with you a hard example that demonstrates it. So you can say, I don't want this webinar to end without anybody being totally clear on what these elements are. The idea is to create quantifiable milestones tied to the specific deliverables. You are going to pick your area that you can create that deliverable in. You're going to create a quantifiable milestone tied to that deliverable. And you're going to identify the increase to the business's valuation as each milestone is achieved. So as you add a certain amount of sales, how much does that add to the value of the business? As you add more sales, how much does that add to the value of the business? So that each milestone not only identifies the amount of what you're going to do here, but it's going to identify the value that's added to the business. I'm going to show you how to do that in just a minute. I want to get all the factors down here. So let's say now you're trying to do this with a person who owns a substantive business, and you're using build-up buy-in to become part owner. So now the business owner agrees to an equity transfer to you that's going to get triggered by the achievement of each of those milestones that you've set, where the percentage of equity given up by the owner is a fraction of the increased valuation of their remaining, albeit reduced percentage. Before I go into it any deeper, in light of the history lesson that we just had, is this starting to seem a little familiar? You are showing the owner a smart way to build their business. You're showing the owner how to use a little bit of what Rockefeller did to dominate the country's economy, how to do that for himself, how to give away some of his business to get additional value for his company where he still remains in control. That's what you're showing the owner how to do. So if I'm going to show the owner how to do this, I'm going to show him the history lesson. I'm going to show him who used this strategy, and he should be as smart as Rockefeller, right? And do it with me, and I'll make him richer, okay? Anyway, you see the point. You see the familiarity here. So I just want to make these points clear as we go. Now, what is an example of the actual numbers of a build-up buy-in? What do they look like? Let's take an example, okay? Let's say there's a company that we've targeted for this build-up buy-in, and they're currently doing $2 million in sales. And their profit on those annual sales are $300,000 a year. So if somebody owns that business, its current annual sales are $2 million. The profit on the sales at the end of the year, after all the expenses, $300,000. Okay, and based on what industry it's in, it's a private company. Its valuation is going to be something on the order of 5 times profit, 5 times EBITDA. People call it different stuff, and so at 5 times the profit, the business is worth $1,500,000. So in one of my meetings with the seller, I would identify, all right, you do $2 million in sales, you got $300,000 in profit. Here are examples of businesses in the marketplace. They're like yours. They all sell around 5 times earnings, and so based on that, your business is worth $1.5 million. And they don't have to agree with you. They just have to agree that the numbers that you're using at least make some sense, and I'll show you why in a moment. All right, so the next thing you're going to show them is, okay, I'm going to bring your sales to $3 million, okay, because I control these big purchase orders. I have clients that I have from something else I'm doing that I can bring with me when I come over here to your company, and those new clients are going to produce an extra $1 million a year for you in this company, okay? I can deliver up to $3 million worth of sales because I can bring $1 million more over. So when we hit $3 million, that's going to be our milestone trigger. The profit on the sales is $500,000. Now, I want to just stress something here. If you add 1/3 more sales, we would have only added profit on annual sales to $450,000, but I showed them as $500. Why? Because once you reach break even, once you are now creating additional sales on top of an existing infrastructure, more of that sales revenue drops to your bottom line. And it's not really hard if you spend some time with the seller, for example, to show him that when he goes from $2 million to $3 million, his profit won't just go from $300,000 to $450,000, it'll go to $500,000. Why? Because his fixed overhead is already paid for. So now his margins get bigger on the sales that you bring in versus the sales that he has now. So with profit on annual sales of $500,000, the business valuation at the same 5 times earnings is $2.5 million. So now if the seller says to you, wait a minute, my business is worth 7 times earnings, then it's worth 7 times up on top, and it's worth 7 times at the bottom, right? So it doesn't matter how many numbers he puts in front of the X. As long as we're comparing apples and apples, you have the ability to show him this tremendous valuation you're adding to his business, because this is what you're adding. His multiple can be whatever he says it is. You know it's 5 times because that's what the market is, and he can think it's 7 times, so use his numbers. The illustration will still work, and you'll still get the same percentages, and everybody will still end up in the same place. All right, so this is the model, okay? This is the model. It says we're going to add, this is a milestone, we reach $3 million in sales, okay, this is what will be true of the company. All right, now let's take the business valuation at those two numbers. Now I want to go back here, okay? So I'm taking the $1.5 million here and the $2.5 million here, and I'm just transposing them over to this page right here. So the business valuation as it exists today is $1.5 million. The business valuation once you've added your sales is $2,500,000. Okay, that's a percentage increase of 67 increase in the valuation of the business. So the milestone equity to you, say, is 15%. The valuation of the 85% owner is the difference, and that's $2,125,000. So that's the amount of value of the business once you've done it. So here, if he does nothing, his business will only be worth $1.5 million. But because he did this build-up buy-in with you and you've hit your first milestone, okay, the business value to him is no longer worth $1.5 million. His 85%, after having given you 50%, is worth $2,125,000. So once he sees that, he'll see why Rockefeller was so smart, okay? And he'll start to see why, yeah, maybe it makes sense for me to give up a percentage of my business to you if you can make my business worth so much more. And then in his head, he starts to think, as long as I don't give up more than 49%, I still control everything, and I'm using paper to get more value into my business. Paper being stock certificates, okay? I'm getting more value, and I don't give anything up to get it except a percentage of the paper. But as long as I own 51%, I own control. All right. Hopefully this is all starting to make some sense. The owner valuation increase, having given you the 15%, is $625,000. That's how much more they're worth. Their business to them is worth than it was if they hadn't done this deal with you. It just makes sense, folks. It just makes sense. Now you're going to repeat this for several additional milestones, right? You have your first milestone, which is the one that we just did. We added $1 million. Perhaps we earned, because we worked there at the company to add that. The company's used to paying commission, so it paid us our commission for producing the revenue. But because of our build-up buy-in agreement, we also earned our 15% equity. Okay, and maybe the second milestone, we had to add another $1 million, so now we've added a total of $2 million. Now we've earned $120,000 in commissions, but maybe now we have a 30% equity. And maybe the third milestone brought us to $3 million in sales. We now have earned $180,000 in commissions. We got to keep the lights on while we're doing this, right? But at that point, we have a 40% equity. So maybe this was our deal with the seller, and the seller is increasing his valuation all the way through, all the way through. He's making his 51% at least that he retains worth a way more by doing this with you, and he still keeps control. So that's what it looks like. So the owner retains control until you're ready to buy them out. See, we use a build-up buy-in to take it another step. We use it because eventually, if we've picked the right business owner to do this with, by the time we've earned out our milestones, that owner hopefully is going to be a little closer to thinking, I'd like to retire. I want to really end up selling the business. We've increased the value of what he still owns, but now let's buy out that value and let him retire out of the business. Okay, and so we use, and everybody should know this number, their variation number 3. It's in the workbook. It's called variation number 3. And we use variation number 3, which is a stock redemption. All right, it's a redemption of the stock by the company. So how do we buy out the owner once we own 40% or 30% or whatever number it is? We don't buy out the owner. We have the company retire his shares, and the company is the one that provides, and we set up all the leverage in the company, the asset-based lenders. It's all spelled out in the workbook how we do it. But we use the assets and the cash flow of the company to now buy out the remaining shares of the owner. And when that happens, our 30 or 40% are the only shares outstanding. So his shares are retired. He got paid for them from the company on the buyout. We arranged all the financing to make it happen. But now our 30 or 40% is the only stock outstanding, and at that point, we own 100%. When we back up a build-up buy-in with a variation number 3 buyout, it becomes a build-up buyout. Okay, so this is variation number 3. You guys can go into the course, into the examples, the M section. You find variation number 3, the workbook, the videos, tells you all about it, goes through chapter and verse exactly how to execute this. Okay, but let's forget this for a moment because we're talking about the buy-in portion of this. Most people agree that what you just experienced, what you just saw in a build-up buy-in, most people agree that this is a great strategy to get into business. It's a great strategy because with talent and connections or whatever it is that you can do to move your resources into that company can gain you ownership in that company, and eventually you can use the ownership that you do own in the company to have the company retire out the old owner, and you end up owning the whole thing. It's a fabulous way to do this, okay, because you don't need money, you don't need capital, you need experience, you need skill sets, you need core competencies, you need all the other stuff, or at least some portion of the other stuff, but you can do this without capital, without cash. That's what makes it so great. All right, now, given what you just learned here and the perspective that you've just gained, let's take this another step and talk about how this now lends itself to the business builder's super strategy. Okay, and so here, but suppose you're building a great business. Okay, now you already now have your business. Okay, and you want to now build that business. Can you see how if this was a great strategy for you to get ownership in a business, that there are going to be other people out there that in your business are going to want to use this strategy to become part owner of your business? Think about that for a moment. It was great for you to get in. It's going to be great for other people to get into business too. And we're going to use that reality of life to harness the vast array of people out there that want to get into business but don't have the resources to do it, but have something you need in order to grow up your business and grow it dynamically. And suppose these best people that are out there won't just work for a paycheck. They got a job now. Okay, they want to own a business. They want to be equity holders. Okay, so they want equity. You can solve their problem, but you don't want to just give away equity, because once you give it away, if they didn't deliver, you've given away equity, and equity is forever, as they say, because if they don't perform, equity is forever. This strategy is a great method for them to gain an ownership interest in your business, where they earn income at the going rate as they go, but they get a share in the equity values that they create. So again, put their hat on, just like when you were looking to get into business using a build-up buy, and once you're in business, other people want to get into business too. So let's harness that. Let's make them our partners in the ways that you're seeing here so that we can attract the very best people out there. You can do this with virtually no risk to you as the business owner. You part only with a share of what they create for you, okay? So if you structure, no risk to you to do this. All right, now, these next steps are going to look familiar. I'm going to show you how to do it step by step. And they're the same steps that we did before when we were looking to use it as a way to get into a company, only now they're just positioned to this is what you do to get other people to do this with you. So to start, you identify people who can make a significant contribution to your rapid growth business. You help them to set up a build-up buy-in with your company. And that lets you attract partner caliber people rewarded by results. You first identify a partner caliber person that can help your business grow, where that person can provide one or more substantive, measurable deliverables. Remember, see, we're just taking the same thing we just did for you on the other side, we're now doing it for you, where those people can add sales, reduce costs, improve cash flow, improve production, open new locations, raise capital, whatever it is, that great thing that they can do for your business is. You create quantifiable milestones tied to specific deliverables that you identify, create the value for your business. Identify the increase to the business's valuation as each milestone is achieved, just the way we did before. Agree to an equity transfer to them triggered by the achievement of each milestone, where the percentage of equity given up by you is a fraction of the valuation increase to your remaining reduced percentage. Same thing, only now that your shoe's on the other foot, right? Now you're the owner and you're using this technique to bring in great talent, great resources into your business. Everything you need to make it grow. And as long as you're only giving up 49%, you're good. And you give up 49%, don't worry about it. You form a new business to do the next thing. And you just make sure on that business, you're going to give away equity, but you keep 51% and you just follow the great John D. Rockefeller. That strategy facilitated the biggest growth, the biggest development of fortune in the United States or in the world ever. And there isn't any reason why you shouldn't use it. Again, following the example, only now the shoe's on the other foot. Current sales, remember, we went through all this is what we had before. Only now we're going to use it to attract the partner instead of the other way around. All right, so now we have the business valuation again, same as before. Remember, this is what it was before we brought in our build-up buy-in participant here. This is what it was after they made their contribution. This was the percentage increase, and now this is what it did for us. Just like we did it for the old owner in the build-up buy-in, now we've set it up so that we help a person do it for us. And then we repeat for several milestones. You can retain control even through the time you go IPO. So in other words, you keep building that structure until eventually your enterprise now is big enough that you can take that whole thing into a public offering. It's a super strategy. And if you do this with several key people, you can build a Goliath company. You can build a Goliath company. Build-up buy-in was a smart way for you to get ownership in a business, and it's a smart way for others to get ownership in yours. Build-up buy-in is a smart way for you to grow your business, and especially when you add to it the John D. Rockefeller strategy. But guess what? It gets even better. The way you're going to help them do this is they're going to form a corporation, okay? Your corporation acquires theirs in a tax-free exchange of shares. In other words, same deal, same milestone, same agreement, same everything, but instead of doing it personally, they set up a corporation to do it, in which they own, to start on day one, 100% of the corporation. So now you have an agreement with their corporation instead of them personally. They own their corporation, so whatever now the agreement fulfills, they are the material benefactors of it because they own what has the agreement with you to do this. The milestone formula sets the amount of shares exchanged, because remember, you're exchanging your shares for the shares of their corporation as they meet and under the terms of as they meet the milestones. So the milestone formula sets the amount of shares that are exchanged and when, meaning when these milestones are hit. This avoids their having to pay income tax on the value of the shares they earn. Why? Because first of all, let's look at if they didn't do this structure that we're talking here. They just did an agreement with you, and now you're issuing shares to them. Every time you issue shares to them as a person for the work they did, the government's going to call that income to them. The government's going to want to put a value on those shares, and they're going to want to tax the value you've transferred to them as income to them. So they get paper, right? They don't get money. They get paper, which has a value. The government puts the value on it and then charges them 30% of that in tax. Now, without having gotten any cash, they got to pay the tax on the value you transfer to them. Not good. Okay, so there's got to be a better way, and there is, to get them that value, and that's that they form the corporation. Then the corporation does the agreement with you, so you're the owner of the company, and you're selling it to them under the terms of the agreement. That's the same build-up buy-in agreement. But now, as the company is doing what it does and creating the deliverables to them, you're earning shares, but your shares are not considered income to you. Why? Because you own the company that did the deal. You exchanged your shares under the terms of this transaction. You're exchanging shares that you already owned for shares in this company that's now the benefactor of the results. And this comes under a special section of the IRS code where you're exchanging shares for shares. You're exchanging shares in your company for shares in the company you're doing the build-up buy-in with. And as a result, those are tax-free. So now you, or they in this case, get the shares that they're entitled to, but it doesn't count as income to them. They just have swapped it for shares that they owned in their own company originally. So when do they pay the tax on it? They will pay tax on it when they sell their shares someday, perhaps in your IPO. But in the meantime, they pay no tax when they get the shares. They pay tax only when they sell their shares, and it's at the low long-term capital gains rates. So it's 15% or whatever that very low number is, instead of ordinary income at 30, 35%. and they get to pay it then when they got the cash, because when they sell it is when it becomes taxable. They got the cash, and I don't mean to cloud the issue, but if they die owning the stock, their estate gets to take the shares and take what's called a stepped up value, and they never pay income tax on the shares, ever. If they die owning it, no income tax is ever paid on those shares. Well, this is the intelligent way to do the intelligent John D. Rockefeller system here. How do we use it to build APS? Okay, we use this structure. Okay, and how do we use it to build accountant partnering system? Okay, well, I'm going to go through it with you in a little bit and trying to give you a hard example of how we use what you just saw here. We need to create a CBS force, a force of certified business strategists to do the cross marketing of the strategic aggregation, which is APS. We need to create that force. A potential partner that we've identified already has done this. They've done something very similar before. They have all the knowledge. They have the intellectual property. They have the experience. They have everything they need to go replicate this for us. So as good entrepreneurs, they also know how to monetize early and grow from cash flow. How did they do this for themselves when they did it in this other example? They identified the low-hanging fruit. They identified what they could do to monetize early to create income very quickly. And then from the income that they created, use that to leverage out the money for the expenses of all the other things that they have to do. So these guys and gals already know how to do this and do it without much cash. They know how to do it with all intellectual property and know-how. Okay, so is this Buildup buy-in a perfect opportunity for them to do it for us? You bet it is. Okay, because they get to leverage our platform, and that makes it attractive to them. In other words, we've accomplished a whole bunch of things ourselves. Now, if they go start this from scratch and go do the same type of thing totally within their own company, then they don't get to leverage our resources, which can help them to do it bigger, badder, faster, and with a bigger payout at the end because of the resources we bring to it once we've incorporated their results into our entity. All right, questions. Anybody have any questions? Pretty cool, huh, guys? Pretty cool. There's a note here from Bob Garrett. It says, hi, Gordon. Bob Garrett in Dallas, your energy guru. We're ready for national business. I know you are, and we're getting right now ready to put all these pieces in place, Bob. So we're definitely going to be working with you to do that. Any questions? Any questions? You guys are blowing me away here. No questions. I don't know what to say. Anyway, this is just a fantastic strategy, folks, and it's not untried or unproven. It's been used literally by the greatest wealth maker of all time to develop and control the most dynamic enterprise that's ever been put together by a human. And it hits all the spots that we need. And the vulnerability of it is only if you take it to the level that Rockefeller did. If you use it to monopolize a whole major segment of the country, you will get resistance. If you use it to monopolize your local market, you'll be fine. If you use it to make a major impact into a major industry, you'll be fine. But if you use it to its extreme, which it's capable of generating, they will stop you. And they will use the antitrust legislation to do that. But until you're threatening at that level, you're safe. All right. If there are no questions, then I want to make sure everybody understands the use of this. It is powerful. It is very powerful. And you are right now, the folks on this webinar and who see it, where most of our people do see our webinars on the recording side of the library, you have been introduced to the keys to the kingdom here. This is the way, the vehicle that you need to create unlimited growth for your business and to co-opt into your business the great talent pool that's out there of people who are frustrated, having created wealth for others and never having had that chance to create it for themselves. They are all going to want to buy into your company using their skills and capabilities to do it, get the ownership share, and then if your goal is to take your company IPO, that's where the big win is materialized for everyone. They end up with publicly traded stock. The multiple at which that stock is valued as a public company will be way higher than it was as they earned it out in coming into your business. So they're going to come out great. All right, Gordon, I need this replay. We'll edit it quickly and we'll get it up there. Give me a week. I should have it up in the library. All right, so I think I've covered everything as much as I can. Thanks. All right, things just keep coming in, but I don't see any more questions. Okay, my question for you, having heard and seen what you just heard and saw, are you the 21st century's next John D. Rockefeller? Because this strategy can build it on almost any field or any business. Like I said, just avoid the extreme. That's all I'm going to caution you. Avoid the extreme. I want to thank you all for your enthusiastic participation here today. And I just want to remind you that we have these webinars twice a month. The second Wednesday of each month, like today, is for Pro. Next month, the second Wednesday, we'll be having another webinar of a Pro variety. But also, everybody on this webinar is also entitled to attend the Essentials webinars, and they happen on the fourth Wednesday. On the second Wednesday of each month, we have our Pro. On the fourth Wednesday of each month, we have our Essentials webinars. So again, thank you for your enthusiastic presence here today. I look forward to seeing each of you on our next webinar.